Good morning, everyone. Welcome to Morning Markets on Thursday, the 26th of March. A couple of things to share with you today. Two positive days of equity market performance. A number of reasons that are contributing to that. I think, firstly, what we've been discussing for the past couple of days, the signing of the stimulus bill in the US. So that was approved in the Senate yesterday. It will now move to the House of Representatives, with President Trump suggesting that it needs to be implemented as quickly as possible, which is a real positive at this point in time. I think the other is just the nature of the market environment that we've been in, and we've seen very significant falls within the equity market, and it's not abnormal to see significant and positive days as we move through dealing with the current situation. I think the other thing to touch upon and is just to reflect a little bit as to what policymakers have learned from the global financial crisis in 2007, 2008. What we saw then was possibly a lack of response initially, and that contrasts to what we're seeing today. We've seen really concerted efforts now by central banks and by governments to mitigate the tightness in financial conditions that we had been starting to see over the past number of weeks. So there is initial evidence that financial conditions are starting to stabilise. One evidence factor of that we look at is the way the US dollar has performed over the past couple of days, and we've seen that weaken ever so slightly against a number of currencies. That's a positive because it suggests that the rush to dollars and the rush to that safe haven currency is starting to mitigate. We continue to get economic data which is indicating the impact that COVID-19 is having on the global economy. The one set of data that we get today that most market participants will be focusing on is the jobs number from the US initial claims. This will be the first indication that we have of how the claimant count has evolved as a result of COVID-19. There's a dispersed range of estimates, I should say, from market participants about what this number could be. I think the key thing is how the market digests the news and how both the equity market and the treasury market react. So that comes out later this afternoon. In Europe, we continue to see movement there, with Eurozone finance ministers discussing a package that could be implemented. I think the thing that's crucial about this package is that there's some indication that it may allow for the unlimited buying of Eurozone member government debt. That's important, as that will help cap the borrowing costs for individual countries and allow them to move forward with their stimulus plans. This would, I suppose, mark a departure from what has happened in Europe historically, and it could be quite an interesting moment to see how this does evolve, because what we will need to see is those stronger Eurozone countries, the likes of Germany and the Netherlands, agreeing effectively to support their weaker counterparts. That's something that hasn't historically happened, but there are signs that things could be changing. One of those is just what we saw in the German parliament yesterday, where they approved an additional package of 156 billion euros. That's equivalent to 4 to 5% of GDP. Crucially, they have also taken the decision to remove or suspend the debt ceiling that was part of the constitution. So that gives you an indication that there is movement there. I think just in conclusion then today, we have seen 2 days of positive equity market performance. It wouldn't be surprising to see equity markets consolidate today, and indeed that's what we're seeing from the indications of the futures markets at this point in time. Thanks for watching, and I'll speak to you again tomorrow.